Well, I hope you all are doing well. I know people will be logging on here. So the first session went just about an hour. So I'm assuming this one will probably be similar, probably about an hour. Let me start setting things up. All right. So again, as always, you can ask questions in the chat, or you can unmute yourself and ask a question that way. Either one's just fine. All right. So give it another minute here because I know a few people might log on to the last minute. So the format that you see right here on the on this review session questions is some of the questions will be similar. When we get to the journal entries, we're doing more like sort of blank, sort of fill everything in. Just as a reminder, on the test, you'll have account names and you'll have to know, is it a debit or a credit, and give the amount and that kind of stuff. But you're not going to have to do like a text box sort of free response kind of answers. So that's probably where the only real difference is. The other thing is like I'm combining a few things where you're doing sort of multiple steps in the same problem, but on the others it'll be more, each step will be a separate problem. Oh, thank you. So someone sent me a congrats on getting tenure, so I just said thank you, appreciate that. It's a huge relief. It was a big deal, so I'm pretty excited. All right, so let's jump into it here. So chapter 21, the first few problems, one is these are just sort of the calculation-based problems where on the first one we're calculating the present value of the minimum lease payments, and on the second one we're going to be calculating the implicit rate in a lease. And so sort of one from the lessee's perspective, one from the lessor's perspective, and we'll have similar problems to that on the test as well. Hold on a second. All right, so let's kind of jump into this. And so we have the first problem here. There's a $350 monthly payments for 60 months. Importantly, it says that payment is due at the beginning of each month, so the payments start immediately. It says that the lessor believes the truck is going to be worth $10,200 at the end of the lease, and 49er has guaranteed $5,000 of this value, and we have the implicit rate given as 12%. Now, on the test, I won't tell you that it's a beginning of the period problem, but I'm just highlighting it here that it is. And the reason that we know that it's beginning of the period is because it says the payments are due at the beginning of each month, starting immediately. And so anyway, so now we have all the information that we need to do the present value of the minimum lease payments. It's just going to kind of walk through this one quickly. So for the N, hopefully it's kind of obvious that the N is 60, which is 60 months. The I/Y might be a little more complicated, not too bad. It says that the implicit rate in the lease is 12%, but of course, the implicit rate is always an annual percentage rate, and this is a monthly payment. Sorry, my dog is. All right, hold on one second. I gotta let my dog out. 1 second. Sorry, I have a 90-pound golden retriever, and so when she decides she wants to go out and puts her nose right in your gut, like, okay, I guess you're gonna go out. Anyway, so the implicit rate is an annual percentage rate, and of course this is a monthly payment, and so we need to kind of match up the interest rate to the periodicity of the payments. And so we have to take that 12% annual rate and we have to get it to an equivalent monthly rate, which is 1%. And so the discount rate is 1%, not 12%. That's probably the most common mistake that I've seen is students will put 12% in there when it's a monthly payment, or let's say it was semi-annual, they'll put 12% instead of like 6%. And so just really pay attention to that. The implicit rate is always given as an APR, and we're asking you to solve, a present value for monthly payments. So we need a monthly interest rate. Present value, of course, is what we're solving for. The payment, from the lessee's perspective, it's a negative $350 because they're making that payment. And the FV is probably the other area where some students might get a little confused because there's two numbers. There's what the lessor believes the truck's going to be worth, which is $10,200, and then there's the guaranteed residual value. What's really important is from the lessee's perspective, we're really concerned about what the lessee has an obligation or commitment in terms of payments. And really the only commitment that they have here is that guaranteed residual value. And so with that guaranteed residual value, that's the $5,000. The $10,200 is not relevant because the lessee doesn't have any obligation, to return the equipment to have it be worth $10,200, but they do have an obligation to make sure that it's worth $5,000. And so that's why the FV is negative 5,000. So when we solve for the PV, we get 18,644. Again, making sure that you set the payments to the beginning of the period. So second payment, second enter, and that will change the setting. So someone asked if we weren't given the implicit rate, we would need the 10,200. Yes, because then we would use that to solve. Now, the only thing that we don't know is what the market value of the asset is. And so from the lessor's perspective, you would need the market value of the asset as well. And so there wouldn't be enough information to solve for the implicit rate in this problem, which is why I gave it to you. But yes, if we had the other information from the lessor's perspective, the 10,200 would be the most relevant number. Yep. And actually on the next problem, we'll see that. Any other questions? All right. All right, so from this second problem, this is the lessor's perspective. And from the lessor's perspective, we're solving for the implicit rate. Again, the two-step really is you solve for the implicit rate in order to get you adopt the lessor's perspective to solve for the implicit rate. And then you use that implicit rate to get the present value of the lease from the lessee's perspective. My dog wants back in, so she's about to bark. 1 second. All right. So, all right. So this is the lessor's perspective. We're trying to adopt that perspective. And so with this problem, we have to get the n first. And so in the chat, or you can unmute yourself, what would the n be for this problem? Sort of read through it real quickly. And what would the n be? Good, good, good. Yes. So it's 40. Sorry, I need to undo that, and there we go. Yeah, so the answer is 40. And the reason why it's 40, of course, is because we're talking about quarters. And so there are 10 years, there are 4 quarters in each year. And so that is 40 quarters. All right, so the answer there is 40. We're trying to solve for the I/Y. And so what is the PV? Again, in the chat, what is the PV for this problem? Again, this is the lessor's perspective. We're trying to solve for the implicit rate. And so we need a PV. And try to be specific on whether the number would be positive or negative when doing our calculations. Okay, so there's the number is consistent. The sign on the number is inconsistent, but it would be a negative sign. And the reason why it's negative is because from the lessor's perspective, they're giving up the equipment. So that's an economic outflow from their perspective on the date that the lease is signed. And then what would the payment be? Again, make sure you do a sign, a positive or a negative as far as the payment. Exactly. Yeah. Seems like we're getting a consensus there. It would be positive 22,500 again, because they're going to be receiving that as the lessor. And then finally, what would the FV be? Again, include the sign as well, whether it would be positive or negative. Good, 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 good. Yeah. So it's positive 150,000 again, because they're going to get the equipment back and they believe that's going to be worth 150,000. That's a positive economic flow to them for $150,000. So we take all that information and we solve for I/Y, noting that we need to make sure we change our settings back to the end because these payments are happening at the end of each quarter. And we solve it at 1.70%. Okay. All right. So now let's move on to the next problem.
I have a question.
Sure.
Uh, I have this calculator. It's HP, whatever.
Okay.
And for the first one, for the first problem, do I use it the payment for only 1 or 12? Is
One.
that
So make sure you set the P/Y to 1 for all problems.
for all problems? Okay.
Yep.
I was getting 16,000 instead of 18,000.
Yeah. So you can change the P/Y, but it's a different process then if you do that. And so I think it's easiest just to make sure your P/Y is set to 1 and then just work everything off of that so you can just have one consistent approach.
Thank you.
Uh-huh. All right. All right. So this next one, it's similar in structure. It's a little bit different in that instead of having you calculate an implicit rate and then kind of go from there, the payments are the same. I just give you a different rate just to sort of create a slightly different problem. But essentially what we have here is, sort of a two-stepper. The first step is to calculate the present value. The second step then is to take that information and start to fill out an amortization table. And so again, the way the test is going to be is they're going to be kind of in pieces. And so you need to know how to put all the pieces together. But on the test, I'm not going to have you do, a present value calculation and then an amortization table and then journal entries. It's just going to be in pieces. And so we're going to put this one together. So the nice thing is a lot of the information is the same as the previous one. Your N is 40. Now again, we're from the lessee's perspective now because we're solving for the present value. And so the payments are on negative 22,500. The FV is a little bit different because the only thing that we have to worry about is the lessee's obligations at the end of the lease. In this case, because there's a bargain purchase price, that is an assumed obligation. So we include that negative 5,000. We're given an implicit rate of 8.5%. If we divide that by 4, we get a quarterly rate of 2.125. Again, just since we've done two calculations, I'm moving more quickly through this one. When we solve for that, we get a present value of $604,375. Okay, so now is where your participation is going to be needed. And so what is the amount that we're going to put as the initial carrying value of the lease? What amount do we put in there? Good. Yeah. 604,375. Exactly. So that present value is the initial carrying value of the lease. What's the payment? Good. Yeah. 22,500. Now, rather than give me the number for the interest expense, I would like you to put in how we calculate the interest expense. So how do we calculate the interest expense for this September 30th, 2020 row? Yep, implicit rate times the carrying value. Yep. Yeah, so we use that implicit rate, the 2.125%, and we multiply it by the carrying value. Now, I want to be clear, though, it's the previous carrying value. So some, Allie kind of said previous. I think Aaron meant previous, but I just want to be very clear. So we're applying it to the previous carrying value. So it'd be $604,375 times 0.02125, which gets us 12,843. And so, of course, with that interest expense and that payment, the amortization of the lease liability, or sorry, of the lease liability is the difference between the two, which is 9,657. And then we take that off, or we subtract that from the carrying value of the lease, which gives us a new carrying value of the lease of $594,718. Okay.
Can you explain the I/Y, like how to calculate that again?
Sure. So we're told that the implicit rate is 8.5%. And so the I/Y needs to match up to the periodicity of the payments. In this case, they are quarterly payments. So there are 4 payments per year. And so we take that annual rate, 8.5%, and we divide it by 4. And that's where we get the quarterly implicit rate of 2.125%.
Thank you.
Uh-huh. Any other questions?
Could you go over, sorry, could you go
Yeah.
over one more time how you got the payment, the 9,657?
The amortization?
Yes.
Yes. So that is the difference between the payment and the interest expense. So 22,500 minus 12,843 equals 9,657.
Okay, thank you.
Uh-huh. Any more questions? All right. All right. So this is kind of similar to what the test would be like. If we wanted to have you do journal entries, I'm going to give you the amortization table. Now, one thing to kind of clarify on this, all right? So if it is a finance lease, the only table is the amortization of the lease liability. And so with the finance lease, that's this table right here gives us the amortization of lease liability. The amortization of the right of use asset, if you recall, we use that straight line method, and I'll talk about how we calculate that, but we use the straight line method for that. And so what I'll do is I'll give you a table without labels, sort of similar to what you see here. And so you have the date, and we know the second column is the payments. Those are the payments. The third column, that's the interest expense. The fourth column is the amortization of the lease liability. And the final column is the carrying value of the lease liability. What's really important is when you see an amortization table that looks like this, the initial amount, that is the present value of the minimum lease payments. The last amount is the residual value of the lease. Hold on one second. Sorry about that. My I don't know what's going on with my dog. She's going crazy. Anyway, so it's really important is when you see an amortization table, this first amount, again, just to reiterate, this first amount is the present value of the minimum lease payments, and the final amount is the residual value of the lease. So you need to be able to understand how these tables work. And so the amortization takes you from the present value to the residual value. That's the whole point of the table. All right. So then now we're doing journal entries. We're worried about the December 31st, 2020 journal entry, and then the August 31st, 2021 journal entry. So we have to make sure that we're paying attention to the amortization of the lease liability and the amortization of the right of use asset. All right, so there's sort of those two processes going on that we need to pay attention to. So the first journal entry is on 12/31/2020, and I think, yeah. So when we talk about the entry amount, there's one important part of this. First of all, is whenever time passes, and I'm going to try not to highlight the number. There we go. Whenever time passes, we know that we're accruing interest expense on a finance lease. And so again, that interest expense column is the third column right here. And so that tells us that 12 months of interest ending 8/31/2021 is $309. The next 12 months interest is $214. And then the final 12 months interest is $111. So that's kind of what this is telling us. And so when I'm talking about how much interest accrues on 12/31/2020, I have to pay attention to, the correct row. In this case, the correct row is the first row, and hopefully that's fairly obvious because 12/31/2020 falls in between September 1st, 2020 and August 31st, 2021. And so it's about, 4 months in between those two dates. And so when we do the entry amount, I think I put it right here. We take that $309 and we know that we accrue 4/12 of it on 12/31/2020. Now, the second piece of the transaction is the other account. Now, just sort of one thing, and it doesn't matter which lease we're talking about. It could be a finance lease or it could be an operating lease. Whenever we accrue interest and there's no payment, the implicit interest when we're talking about an operating lease, or the actual interest expense when we're talking about this situation, a finance lease, the interest accrues to the lease liability. Again, I want to reiterate, it accrues to the lease liability. And so when we accrue it to the lease liability, we're going to credit the lease liability $103. So we're temporarily increasing the balance in our lease liability account by $103, because now it not only reflects the present value of the minimum lease payments, the $3,866, but it now also includes the accrued interest. It's just kind of really important that you understand that this snapshot in time, that lease liability actually goes up as far as its account balance because of the accrued interest. Now, I want to stop there real quick before I move on, in case anybody has any questions or doesn't quite understand that. Okay. There's also a second journal entry on 12/31/2020. Oops. Let's see if I can grab the right line. And that is the amortization of the right of use asset. And so we have the amortization expense, which is a debit. There's a way that we calculate under the straight line method. We take the present value minus the residual value and divide it by n. That's how we calculate it using the straight line method. And so again, just to reiterate, the present value is that initial carrying value of the lease liability. The residual value is the final value in the amortization table. And so that tells us we can fill in the amounts. The present value is $3,866. The residual value, again from the table, is $0. And the n we can see is 3 years, or 3. And so that tells us that the annual amount is $1,289 per year. But of course, in the current year, in 2020, there's only 4 months, from September 1st all the way through December 31st. So there's only 4 months. And so the amount for 2020 is $430. And again, it's the amortization expense, and we are amortizing or reducing the balance of the right of use asset. The normal balance of the right of use asset, of course, is a debit. And so the amortization is going to be a credit to that account, reducing the right of use asset account balance. Any questions on that? All right, so again, for a finance lease, those are the two journal entries we have to be aware of at the fiscal year end: accruing interest and amortizing the right of use asset. And then during the year, really the only thing we have to worry about is any payments. In this case, of course, there are payments. there's a payment on 8/31/2021, and we need to provide that entry for August 31st, 2021. Oops. All right, so when we record that payment, the first thing we have to note is that there is additional interest expense. And the reason why is because time has passed. The last time we recorded interest expense was 12/31/2020. It's now 8 months later. And so we've had additional 8 months of interest. And so we're doing our calculations. The first calculation is that interest expense. And of course, we know that 12 months of interest expense is $309. We've already recorded $103. And so that tells us that the remaining interest expense is the difference, which is $206. Again, we're just recording the last 8 months of interest expense. The next amount that we have to calculate, and this one's probably a little more difficult, is we do need to also calculate the lease liability entry amount. Now, with this problem, or with any lease problem, when we think about what's happening with the lease liability, whenever there's a payment, that's when the amortization is taking place. And so if we think about the amortization, we're reducing the lease liability account balance. Now, whenever we have a situation where the payment happens in the middle of the year like this, there's two pieces to it that we have to pay attention to. The first piece is the table amount. And we can see that the amortization for the lease liability is $1,191. We can see that that is the amortization amount for the lease liability. However, we also accrued $103 to the lease liability as well. And so what that tells us is that the lease liability actually has two components. It has the table amount, $1,191, and it also has the entry amount of $103 from 12/31/2020. And so that tells us that the total entry amount for the lease liability is $1,294. And that's true whether it's an operating lease or a finance lease. We have to pay attention to both the table amount and whether there's been any amount that's been accrued to the lease liability account since the last time we recorded amortization. And so in this case, that total amount is $1,294. I'm also going to show you, though, that we could end up just plugging that number if we needed to. All right, I'm just going to show you that in a second. The second piece I want to ask, though, is we have the amount, $1,294. Is that going to be a debit or a credit to the lease liability? Is it going to be a debit or a credit to the lease liability? Go ahead and put it in there. Good. It is a debit because we're reducing the lease liability account. So we're going to debit that account, $1,294. Now, the reason why we could have done a plug is something that some students just forget, which is that, oh, wait, we have a payment. So we know that there's going to be a credit to cash for $1,500. So that's going to be part of the journal entry no matter what. We calculated the interest expense, and the only other account that is part of this journal entry is the lease liability. So we can plug in the $1,294, or we can calculate it. You know, either way we can get to the answer. Now, I will say, if you can understand why it's $1,294, you are in a much better position than if you're just trying to plug it in and hope that you got it right. I think understanding why is really important, that you say, okay, wait, I'm amortizing this lease liability, but I also accrued interest to it, and so I need to account for both. But let me stop there in case there are any questions, because typically, especially this second journal entry, that's where some students can start to get a little tripped up. Any questions about this problem?
I have a question, Professor. Sure. So that 309 amount from the interest expense, we don't include that in that calculation because that's pulled from the table. Is that correct?
Yes. So this interest expense right here, this 309, that is 12 months of interest expense from September 1st, 2020 through August 31st, 2021. So we had already recorded some of it, the 103, and then we're just recording the remaining amount. So we just take that directly from the table. Now, could you calculate it? Yes, but you could take 309 times 8/12, and you get 206. But I think of it this way in case there's like rounding issues.
Okay, thank you.
Mhm.
Can you explain why you add 103 to the lease liabilities again?
Yes. So in total, we know that according to the table, the lease liability account balance needs to be $2,675 as of 8/31/2021. And so all things equal, we know that the net amortization needs to be $1,191. In other words, the total reduction in the account over that year needs to be $1,191. Okay. So think about this. On 12/31/2020, the lease liability was increased by $103. And so if we kind of do that math real quick, the new balance, 3,866 plus 103. So the new balance in our lease liability account as of 12/31/2020 is $3,969. As of 8/31/2021, the balance needs to be $2,675. And so if I take the difference between those two, the 3,969 minus 2,675, you're going to see that comes to $1,294. That's the entry amount. Now, I think it's difficult to kind of follow all of that. So a simpler way in my mind to think about it is to say, okay, whenever I amortize the lease liability, there are two amounts that I need to pay attention to. One is any amortization that's explicit in the table, and that's the $1,191 right here. But we also need to include, or we need to make an adjustment or record the fact that there's been an additional $103 added to the account, which is why we add the 103 for a total of 1,294. That is the most difficult concept to understand when it comes to amortizing lease liability is when you have to add that 103, you have to take that 103 back off whenever you actually have the payment. I hope that helped, but I know it's a tough concept.
That did help a lot. Thank you.
Okay, good. Any other questions? Okay. All right, so this next problem, now we're transitioning to an operating lease. And so we have some information about a 2-year annual lease that's signed on April 1st. There's an immediate payment. I give you the implicit rate. I give you the present value of the minimum lease payments. I give you the residual value. I give you a lot of information. And so now I'm asking you to fill in the two tables. And by the way, there is a question like this on the test. So fill in the tables. Now understand that there's two tables whenever you have an operating lease. One is the lease liability amortization, and the other is the lease expense schedule. Now with an operating lease, the only expense that we're going to record is a lease expense. That's sort of the point of the operating lease treatment under US GAAP is we only have a lease expense. However, the process of amortizing the lease liability still takes place even with an operating lease. So that's all happening behind the scenes. And so you have the amortization of the lease liability, the steady recording of a lease expense, and then sort of what reconciles those two together is the amortization of the right of use asset. And so there's really kind of, if you think about it, 4 things going on. You have to record the payments. Hopefully that's the easy part. You have to record the lease expense, which shouldn't be too hard. And then the two pieces that kind of fit behind that is the amortization of the lease liability and the amortization of the right of use asset. The amortization of the lease liability is calculated the same way that we calculate it as if it were a finance lease. And so the first table, this lease liability table, is exactly the same. It's done the same way. The difference, though, is how we handle the lease expense schedule. That's where it gets more complicated. All right. So again, that's how these two things fit together. The lecture goes into a lot more detail on that, but that's kind of what's going on. We have the payment, the lease expense, the amortization of the lease liability following, the amortization schedule here, and then the amortization of the right of use asset that kind of fits it all together. It's just a mechanism to reconcile everything, and so we've got to think through that. All right. So let's start filling in this lease liability amortization table. Now notice that we have signed the lease on April 1st, 2020, and there's an immediate interest payment. Or sorry, an immediate payment, not interest payment. There's an immediate payment. And so given that there's an immediate payment, again, this is the payment column. This is the interest column. Now I'm not going to say interest expense. And the reason why I'm not saying interest expense is because with an operating lease, there is no interest expense, but there is inferred interest. So this is the inferred interest column. So we use the payment and the inferred interest in order to get the amortization of the lease liability. And the amortization of the lease liability then gives us the updated carrying value of the lease. So again, notice we start with the present value of the minimum lease payments, and we end up at the residual value. That will always be true for the lease liability amortization table. All right, so given everything that I said, and given these first two columns, what is the amortization of the lease liability on April 1st, 2020 using this table? Good, it is $1,000. Yep. And given that the amortization is $1,000, what is the new carrying value of the lease liability? Good, good. Yep, $1,392. Good. All right. Now, given this payment on the next year, 1 year later, this payment, the $81 is calculable. I calculated it for you. But given these two numbers, what is the amortization on 4/1/2021? Good. 919, which gives us an updated carrying value. I'm just going to give you that of 473. All right. Now this last row, whenever you have a beginning of the period payment, is the most difficult for most students to understand. All right. But I'm going to hopefully kind of let you navigate your way to it. What is the payment on 3/31/2022? The payment. What is the payment amount? So somebody privately told me 1,000, and then Kyler says 0. One of those is right. All right, so here's what I'm gonna do. All right. Don't have to say it out loud, don't have to put it in the chat. But on the count of 3, in your own mind, say 1,000 or 0. In your own mind. 1, 2, 3. And were you right? So sometimes that little mental exercise is actually helpful because you're like, oh, okay, if you got it wrong, then you know, okay, wait, I did something wrong. Now, the reason why it's 0 is because the contract calls for one payment on April 1st, 2020, and another payment on April 1st, 2021. It does not call for a payment at the end of the lease because all the payments are at the beginning of the lease. And so that tells us that there's a 0 payment here. All right. Now, here's the hard part. So you get the 0 payment. How do we go from 473 up to 500? What must the amortization be? So Kyler says negative, and that is correct. So amortization normally takes an account balance down. And so if we're going to bounce back up, that means we need to have negative amortization. And some people are putting the number in correctly. Good. It is negative $27. So it is negative amortization. What does that tell us then about the inferred interest? What must the inferred interest be?
Say something.
Say that again.
Can I say something?
Yes.
The $27 is also when you multiply 473 times the 5.8%.
Yes, exactly. So you can also directly calculate it by taking the implicit rate, 5.3% times 473, and you're going to get the $27. Yes, so you absolutely can calculate it as well. Yep. But notice when there's zero payment, but there's still an interest expense, that's when you have a negative amortization and it bounces the lease liability back up. Because if you think about it, really what's happening conceptually is I've accrued interest on this liability, but I didn't make a payment. So what happens to a liability if you have accrued interest on the liability? Well, the balance goes up. And so that's what we're showing right here. Okay, so for the lease expense schedule, all right, just let me kind of clarify what happens with the lease expense schedule. First of all, on the lease expense schedule, we begin and end and the same amounts as the lease liability amortization. So the beginning and ending must be the same. All right, what does that tell us about the beginning amount right here? How much must the beginning amount be? Good. And what must the ending amount be? Good, 500, exactly. So we can get the beginning and ending amount from the beginning and ending amount on the lease liability. They must be the same. So whenever you have the lease expense schedule and lease liability amortization table, they both begin and end with the same amounts. Now, the second piece that's really important to this is that this inferred interest, this is the mechanism that connects the two tables together. This is the mechanism that connects the two tables together. And so we have to think about dates. Now, notice that we have end of month dates here, and we beginning of month dates here, and an end of month date here. All right. Notice that on 3/31/2022, the inferred interest in the lease expense schedule and the inferred interest in the lease liability amortization table are exactly the same. And that's how they're connected. The interest connects the two tables. And again, I want to be very clear. There's not great intuition about why it's this way. It's just the only way that it can work. In other words, under US GAAP, there's what I think an intuition sort of absence. And they're just saying, hey, we want to have an even lease expense. We want to amortize the lease liability using the effective interest method. So what do we do to make it all work? Well, this is how you make it work. You connect the two tables using the inferred interest. And so what date closely matches the March 31st, 2021 date? What date in the lease liability amortization schedule matches that date or is kind of at the same time? Exactly, the 4/1/2021. And so look at the inferred interest on that date. It's $81. And so you marry the two together and you say, okay, well, that means that I need to bring down that inferred interest into my lease expense schedule. So they're connected through the inferred interest. Okay. Given that lease expense and given the inferred interest, what must the amortization of the right of use asset be? Good. It must be 919, which means what must the new carrying value be? $1,473. Now Kyler put 1392 because she probably took this number from up here and brought it down. But there's a complete disconnect between these two columns. We begin and end at the same place, but the path completely different in between. And so you have to calculate the carrying value by taking the amortization amount, subtracting it from the carrying value from the previous row, and now we have an updated amount. And then therefore, what must the amortization be on 3/31/2022? Good, 973. Okay. So putting that table together is a challenge. There's no doubt about it. There's going to be one on the test. So you need to be prepared to put that table together. Now on the test, I won't have you then do journal entries. I'll just tell you right now, I'm not going to have you do this table and then do journal entries. They'll be separate for the journal entries. And so just be aware of that, so that you complete the table sort of as one problem, and then I give you a table or tables and allow you to do the next one. So someone asked if the dates aren't close to each other. So they will always be matched up. They might be like a beginning versus ending, but they will always, because the way that we record the payment and the way that we accrue the lease expense is kind of a similar process. So someone asked, why was there a $1,000 payment on 3/31/2022? Well, it's not a payment. This is the lease expense schedule. So remember, lease expense is incurred as time passes. So we basically, if you want to think about it, it's every day, it's the same amount. So lease expense is sort of a continuous thing, right? And so we accrue it at the end of each 12-month period
Do
using
you
the
have
table.
do you have time to explain one more time the second table?
Sure.
If you don't mind.
No, fine. Yeah. So the first column is the lease expense. And that's just, it's going to be, we always have the lease expense sort of line up to the end of each period. Now it's a continuous process. It's always a continuous process. The second column is the inferred interest. And all we're doing is we're matching it to the table above. And so you can see that 3/31/2021 and 4/1/2021 kind of match up. So that's why we're bringing them together. And then obviously 3/31/2022 matches to 3/31/2022.
Oh, the dates, the difference in one date threw me off.
Yeah, and you got to pay attention to that. When it's the beginning of the month, it's going to be off by one day. If it's an end of the month or end of period payment, then you're good. It'll just be all matched up. And then the amortization is just the difference between the lease expense and the inferred interest. And of course, then we subtract the amortization in order to get the updated carrying value. Is lease expense always identical to payments? For this class, yes. In practice, no. Because you could have lease payments that aren't even. You could have like balloon payments and weird things like that. In that case, it'd be different. But for this class, we're going to always keep it simple. Oh, not that this is simple, but relatively speaking. All right. All right. So last problem. So now we're going to do journal entries. All right. So in this case, it's an operating lease. And in this case, the payments happen at the end of each period. Now, if the payments happen at the end of each period, the lease liability amortization table and the lease expense schedule are identical. So what that means is this $1,000 right here, right? That is the payment and also the lease expense as of that date. So that's the payment that will occur on 4/30, and it's also the lease expense that will be incurred over the 12 months ending 4/30/2021. So they match up. The inferred interest matches up, and then the amortization of the right of use asset and the amortization of the lease liability are the same, 7/13. And then the carrying value of the right of use asset and the carrying value of the lease liability follow the same path as well. So everything matches up. All right. So whenever the payment happens at the end, it's a much simpler problem because the two tables are identical. All right. So given these identical tables, knowing that it's serving a dual purpose, keep that in mind. It's serving a dual purpose. Let's provide the December 31st, 2020 and the April 30th, 2021 journal entries. Now, one thing I want us to keep in mind, when you have an operating lease, the only expense that we are concerned about is the lease expense, and it is straight line. So every day it's the same amount. All right. Now, over a 12-month period, the total is $1,000. right? So when we think about that, saying, well, 1/12 in the first month, 1/12 in the second month, 1/12 in the third month, and on we go. So then when we come to December 31st, 2020, one account we know we're going to have is a debit to the lease expense, because that is the expense that we're concerned about. It's accruing continuously, it's recorded periodically. And so we have that lease expense amount. And so when we do our calculations, the lease expense hopefully isn't too hard. We know that a full year is $1,000. 8 months occur in 2020. So the lease expense is $667. Okay. Now is when it gets a little more complicated. So really kind of focus in and pay attention, because most students really struggle with the next piece. What's really important is the lease liability is following an amortization process. It is, in a sense, independent of the lease expense. Now, in this case, it matches up, but they are two separate processes. And so let's view this table as an amortization of a lease liability. That's how we're going to view this table now. It's the amortization of a lease liability. And so what that tells us is that from May 1st, 2020 through April 30th, 2021, we're inferring a $287 interest amount. That interest amount, if unpaid, accrues to the lease liability, just like a finance lease. An unpaid interest amount accrues to the lease liability. That's just a truth that you need to know. It accrues to the lease liability. So on December 31st, 2020, there is no payment, but is there interest? Just give me a yes or no in the chat. Is there inferred interest as of 12/31? Yes, absolutely. Does anybody know how much that inferred interest amount would be? Is it the full $287? Good. No, it's not. Does anybody know the amount that it would be? Good. It's 8/12, because 8 months of interest, of inferred interest, accrues in 2020. Now, the question is, if that interest accrues to the lease liability, is that a debit or a credit to the lease liability account? Yes. For most of you, there's one private person that got it wrong, but it is a credit to the lease liability account. Again, we're accruing interest to the liability. That's going to increase the liability balance. That's a credit. Now, obviously, we have a problem, right? Debits don't equal credits. Now, if you remember right at the very beginning, I said we have the lease expense that we want to record. We need to amortize the lease liability following the effective interest method. We need to record the interest, or we need to record the lease payments. And then I said that the amortization of the right of use asset is the mechanism for tying that all together. So whenever we see a disconnect, our first thought when we have an operating lease should be amortization of the right of use asset. That should be our first thought. And so given this disconnect, is there a payment? Is there any sort of partial payment on 12/31/2020? Does the contract call for a payment on December 31st? No, it does not. So we know cash cannot be here. Well, there's only 4 accounts that there could be. Lease expense, lease liability, they're already there. Cash cannot be there. The only other count, right of use asset. And so that means we have an entry amount to the right of use asset. There are 2 ways to get that entry amount. I'll just highlight the whole thing. You can calculate it, or it's a plug. I'm going to encourage you to calculate it. And that is the wrong number. I'm going to encourage you to calculate it. And the reason why I'm going to encourage you to calculate it is because it allows you to understand why. because we know that this schedule right here, not only is it the amortization of the lease liability, but it is also the lease expense schedule. Within the lease expense schedule, this column right here is the amortization of the right of use asset. And so what it tells us is that over the 12 months ending April 30th, 2021, we need to amortize the right of use asset a total of $713. Well, given that 8 months have passed, that means we need to amortize 8/12 of that $713, which is $476. But it's also true that the amortization of the right of use asset must reconcile the lease expense with the amortization of the lease liability and any payments on the lease. And so so basically it's one or the other, you can get there. The entry amount needs to be $476. It'd be great if you understood why you have to amortize the right of use asset $476, because you'll do much better on the test if you understand why, and just you'll be a better accountant, obviously, which is probably, well, immediately it's probably not the more important thing to you, but in the long term, it should be the more important thing to you. But I'm going to stop there. Does everyone understand, at least on some level, what we did with each of those accounts?
Yeah, because you got 8 months, so you gotta subtract 4 months from.
Yeah, it's not the full 12 months. Yep, you only had 8 months in 2020. Any other questions? All right, so now we have the April 30th journal entry. Now I will say, traditionally, this is the journal entry that students struggle with the most. Of all journal entries, maybe in intermediate 2, I'm not kidding. This is the one that students struggle mightily with. So now help me out. What is the one account that we know must be part of this journal entry? At least one account. I like Aaron. Cash, right? Why cash? Because that's the contractual obligation to pay, right? They got to pay $1,000. And so is that going to be a debit or a credit to cash for the lessee here? They're making a payment, debit or credit? Good, credit. So we're going to credit cash. See if I can grab the right line. It probably won't. Ah, dang it. All right, we're going to change that to white. And I think it must be right above it. There it is. Cash. We're going to credit cash $1,000. All right. What's another account that seems like it should be hopefully fairly obvious that it's got to be a journal entry? Lease expense. Lease liability maybe too, but I think lease expense, in my opinion, is the second most obvious, because that lease expense is getting incurred continuously and it's recorded periodically. And the two reasons we would record it would be a fiscal year end or payment. And in this case, we have a payment. And so we need to record the lease expense. Well, how much? Hopefully it's not too hard. We know that again, this is the lease expense schedule. Remember, this is the lease expense schedule. And it says as of $1,000, we need to have recorded, as of 4/30/2021, we need to have recorded $1,000 of lease expense. We've already recorded $667, which means we have another $333 left to record. Okay. All right, the next one. All right. Somebody mentioned the lease liability. Someone mentioned the lease liability. So let's talk about the lease liability. All right. What needs to happen with this lease liability? Just think about that. What happens with payments? If we're following the effective interest method and we're amortizing a lease liability, what should happen to the lease liability account whenever a payment is made? Should the account balance go down or should it go up whenever a payment is made? Yes, it should decrease, it should go down. Okay, good. So will that be a debit or a credit to the lease liability? Good. We're going to debit the lease liability account. All right. Debit the lease. Now the question is how much? Now I'm going to give you a clue. When we debited the lease liability account up here, I said there were two things we needed to think about. We needed to think about the table, and we needed to think about any amounts that had been accrued to the lease liability before the payment. All right. Two things, the table amount and anything that accrued to it beforehand. So let's go down here. And let's think about what the journal entry amount might be for the lease liability and see if you can come up with the number. This is the toughest, probably the toughest number, maybe in all of intermediate too, the toughest number to come up with right here. Good job, Kyler. Also, somebody direct messaged me and got it, and Jessica got it. Good job, 904. Remember the two sources, right? Table and any previous accrual amounts, which was from 12/31/2020, right? So we add those together, and that gets us the 904. But of course, when we do the math, does everything add up? Remember, there's a lot of things going on. We have to record cash payments. We have to amortize the lease liability. We need to record the lease expense. And then what's the piece that mechanically ties it all together? The amortization of the right of use asset. And so in order to complete the journal entry, we need to make sure that we amortize the right of use asset. And the amount, $237. Two ways to get that amount. One is, again, this column right here represents the amortization of the right of use asset. We previously amortized $476, which means the remaining amount is $237. We also know that the amortization of the right of use asset can be a plug when we have an operating lease. And so we could also just be a plug amount. I prefer that you understand the calculation, but you probably will get there as long as you understand that it's a plug amount as well. But like I said, this, I think, is the most difficult journal entry, maybe in all of intermediate too, to understand. Because it is not intuitive, not even close. It is not an intuitive journal entry at all. Someone asked, will you have to know? Yes, you have to know the 5 criteria. Yep. Now, I'm not going to be tricky with it. It's going to be, obvious. Any other questions? All right, everyone. Thank you so much. If you have any questions, please let me know. Yeah, so someone said it seems strange to record amortization as an adjusting entry to the lease. Well, the whole idea when US GAAP, so when they redid the lease standard a few years ago, there was a strong argument that we should treat all leases as finance leases. They actually didn't want to have operating leases as an option. And in fact, under IFRS, it isn't one. They can't do them. But there was a strong pushback, basically because a lot of companies didn't like. I'll answer it the same way. Didn't like dramatically changing the way leases were handled because it would actually really change their books. And so this was a compromise. And essentially what they said is, well, FASB said, the Financial Accounting Standards Board said, we're going to force you to amortize the lease liability because under the old standard, there was actually no liability at all. They wouldn't even have it on their books. It's like it didn't even exist. And so they're going to force you to have liability, you need to amortize the liability because we're going to infer this interest charge as part of your lease arrangement. But at the same time, those who were against the new standard got the even lease expense to stay there. And so we have to do all this craziness with the right of use asset in order to reconcile everything. It just was a, I think it's a matter of time, honestly, before we under US GAAP conform to IFRS, which would do away with this operating lease even as an option. Everything would be a finance lease if it was over a year, just done. Any other questions?
Question about the email for the exam.
Yeah.
Ongoing facial recognition. How it's supposed to calculate on the paper?
So as long as you kind of work and then look up and then keep working, it's a pain in the butt. But I asked around and everyone said that is, as far as colleagues, they said, if you want to, I guess, curtail stuff that could happen, forcing the facial recognition to be recurring is really the only way. And even that's not 100%, but they just said, it's a reasonable thing to ask students to do. It's going to limit, because there are some students who, when I look at the video, it looks like this. I have no idea what they're doing. Right? And so the only way to kind of force at least some sort of visual is to have that facial recognition be recurring. And someone asked if you can still use your notes. Absolutely. You can still use your notes. Just understand though, if my notes are sitting over here and I'm taking 5 minutes to look something up, it's probably going to pause my exam. So you just have to be a little more just aware. Exactly. So someone casually look up. Yeah. So you just need to kind of keep making eye contact with the webcam. Yep. So you can look down and look up and look down and look up. You have 2 hours to take the test. So, you'll have more than enough time. I understand it's a little bit of a hassle. I just, with this online testing environment, it has some inherent challenges that we can't get around. And again, I think, and I hope everyone at this point is kind of decided that, you know what, I'm going to do the right thing. I really do. But I felt like I was being a little loose, and especially I've been more loose than a lot of my colleagues have been. And so I felt like, okay, at least let me conform a little bit more to what some other people are doing without being vindictive or, because I'm not doing that. I'm not going after people. I just thought, okay, this is a small change we can make and create a little more accountability.
Well, the university is open, so we can come over.
What's that?
The university is open, so we just can come over if that's the
Yeah,
case.
unfortunately, that's not an option for my class. They didn't give us that option. Any other questions? All right, everybody. Thank you so much. Feel free to email me. Have a good weekend.